Welcome to Home Buying Made Easy podcast. We are here today to talk through debt to income ratio. Was I supposed to say that, Rachel? Or was I supposed to let you have your glory again?
What are you giving me?
Yeah. Okay. I got Rachel here. I'm Michael and Rachel's here. And we talk about everything there is to know about home buying and the process and Home Buying Made Easy. And that's why I wrote the book, Home Buying Made Easy. So let's get started.
Yeah, we're talking about debt to income and what that looks like and what lenders look for and all the things. So the first question I want you to answer is, what exactly is debt to income? What is the ratio? What does it mean? Why does it matter?
Okay, so debt to income ratio means if you have a certain amount of debt and a certain amount of income, how much is the ratio between those two? So let's say you make $5,000 a month and you have $2,500 in debt. That's all the pieces of debt that you have. You have a 50% debt to income ratio. That is the bare bones minimum answer.
Great. Why does it matter?
Well, lenders like to see that you have the ability to repay. Way back in after the housing crash and everything, and mortgage brokers and mortgage companies and loan officers ruined the mortgage market. They decided that there was a law put in place that requires lenders to determine if someone has the ability to repay. And part of the ability to repay rule is establishing debt to income ratios, like a maximum amount that would be allowed for your the amount of debt you have.
Oh, okay, great.
What?
Sorry, it was a quicker answer than I was expecting. So
you're expecting me to be long-winded again, huh?
Well, I mean, yeah. So how do lenders calculate that DTI? What's included and what's not? So student loans, car loans, personal loans, stuff like that.
Gotcha. Okay, so front-end DTI or debt to income ratio is just the housing. So if you have in a mortgage payment, you have a principal, you have the interest, you have taxes, you have insurance. That would be made up, and even an HOA, even though HOA is not part of the mortgage payment, it is a housing expense. That would all be made up of the housing debt to income ratio. That's the front end. The back end is the housing plus all additional debts. So if you have $500 car payment, and then you have another $300 in credit card payments, just the payments, not the balances, but the payments. So you take that $800, the $500 car payment, the $300 plus the mortgage, all of that combined is the back end debt to income ratio.
Okay. So when should someone start working on their DTI before applying for a mortgage? Is there a certain amount of time or?
Well, that's kind of tricky. I think if you have a lot of credit card and consumer debt, you really need to watch that, because consumer debt can get out of hand pretty quick as far as payments and stuff. And they're adjustable rates. They're not a fixed rate.
Right.
Car payments, if you have a car payment and it's a super high car payment, let's say you got a car and you got it a few years ago and you didn't have really good credit, and then your interest rate was a lot higher, but now you have better credit, you may want to look at refinancing, because maybe you had a $1,000 payment and you could refinance the car payment into a $600 payment or a $500 payment. That would be one thing that I would look at. That would really work to your advantage on your debt to income ratio. Just making sure you have control of your credit cards and consumer debt, any Affirm and Klarna payments and stuff like that. That's going to help. But as far as when you apply for a mortgage and you start the pre-approval process, we're going to calculate whatever debt is there. So if your debt to income ratio is too high and you have some money that you could put towards one of the bills to get rid of one of those payments, that's going to bring that debt to income ratio down below what the lenders are looking for.
Okay. And I know that when you're going through the pre-approval process, the lenders look at a lot more than just your debt to income. So what DTI, debt to income, do most lenders look for? Like, is there a certain percentage that they usually won't lend you the money after, or is that just based on the pre-approval?
There's a lot that goes into that question. So a couple of things. You could do a conventional loan. So guidelines are different for every type of loan. The guidelines, and even Fannie and Freddie, we talked about Fannie and Freddie, brother and sister. I mean, not really brother and sister, but Fannie has a 50% debt to income ratio. That's the limit. You cannot go any higher than that.
Okay.
They also have a front end debt to income ratio number, but it's sometimes flexible depending on what's called compensating factors. Okay. Freddie will allow you to go to 50.49.
Wow.
So they say 50% is under 50.49. So Freddie will let you go up to that.
Okay.
The guidelines for FHA are higher. They're up closer to 56. So they have a little bit more leniency in their debt to income ratio. But here's the stickler. I've done loans before where we were at 33% and it doesn't work. And the reason it doesn't work is because a lot of times the loan file, when you go and put this information into Fannie's system or Freddie's system, software system, they will look at it and they'll determine if this is too high of a risk. If it's too high of a risk based on the credit score, based on the debt to income ratio, based on the just the overall credit situation and what happened in the past, they could, sometimes it looks at it and goes, I just don't really like this. And then you don't get that approval that you're looking for.
Yeah.
So debt to income ratio can vary depending on the program you're in. Okay. There's some that have maximum. VA loans, they don't have a maximum. So you might be at 60%, and it might be fine. But then it might not be fine because of the credit situation. I mean, it's not just like black and white, like, okay, as long as I get it here, it's good. Yeah. It doesn't work like so yeah, I think lenders are looking to make sure that you have the ability to repay. They're not just looking at a debt versus an income ratio. Now they are, if they're trying to fit inside of a box, if they're trying to fit in the Fannie box, they want, or the Freddie box or the FHA box, they're going to be looking at that debt to income ratio because there's a maximum that you can go to. And once you get past that, it's no longer a viable loan as it is that way, for automated reasons, for software.
Yeah.
At that point you can do what's called manual underwrites, which is a whole different ballgame.
Wow.
But I don't know if that lays out all the details. But.
Yeah. And that's the last question I was going to ask about this, and we can end the episode here.
All right. Well, if you have other questions about loans, mortgages, pre-approvals, debt to income ratio, or you want a free book, I'll be glad to send you a book too, or you can get it on Amazon if you really want to. I'm not here to really sell books though. So really, if you want a free one, I'll give it to you. Just shoot me a text, give me a call, and we'll be glad to help answer any questions you have. We'll see you next episode.